Hello everyone, and welcome back to Dr. Tao's Quant Lab. Over the last few lectures, we mastered the trend engine. We learned how to analyze the volume, direction, and the momentum of a single stock. But here is the dash reality of quantitative finance. No stock trades in a vacuum. If a macroeconomic tide is crashing out, it will drag down even the best looking chart. To protect our capital, we must zoom out and analyze the health of the entire market. Today, we're opening chapter section 2.4, and we are mastering macro breadth. The most dangerous illusion in the financial markets is the price of the S&P 500. Major indices are market cap weighted. This means that massive trillion-dollar companies like Apple, Microsoft, and Nvidia dictate the direction of the index. Because of this, it is mathematically possible for the S&P 500 to hit a brand new all-time high, while 400 out of 500 stocks are actively crashing. If you only look at the index, you will think we are in a massive bull run. But if you look under the hood, the engine is actually failing. To see under the hood, quantitative traders measure breadth, which is simply market participation. Every day, we calculate net at once. We take the exact number of stocks that went up, and we subtract the number of stocks that went down. If we strictly filter this data to the S&P 500, we get an indicator called ADD-SPX. Look at the chart on your screen. Because there are exactly 500 stocks in the pool, the mathematical limits are positive 500 and negative 500. However, in reality, all 500 stocks almost never move in unison. So practically, this indicator behaves like a rubber band, stretching between 300 minus 300 and 300. While the A and D line is great, we need an oscillator to measure its exact momentum. We use the premier breadth indicator, the McClellan Oscillator or MCO. If you look at the math, you already know how to use this. The MCO shares the exact same algorithmic structure as the MACD we studied earlier. The only difference is, instead of analyzing the price of a single stock, it calculates the spread between a fast-moving average and a slow-moving average of the entire market's net advances. Why did the McClellan choose 19 and 39? Because breadth data is wildly volatile, statistically a 19 period and a 39 period EMA apply exactly a 10% and a 5% smoothing factor to the data. It is the mathematically perfect filter to eliminate daily noise while capturing micro trends. Now, if your trading app does not have this built in, you can build it yourself. In the textbook, I have provided the exact Python script to code this into Moomoo using the fta.ema function. So let's see this in the app. Okay, so let's take NVIDIA as an example. So to see the ADD SPX, you just need to search it from the indicators, and you can see that in most of the trading apps. And then for MCO, some of the trading app, for example, like this one, they doesn't have MCO. So what you can do is that you can create a new one. Okay, and then just copy and paste the code from the lecture notes. Okay, so you can search uh, for MCO, which is the new notes, and then you can just copy and paste the code right here. Okay, so after you copy the code, you can see this two indicators, and we can look at these two indicators from your screen, that ADD, SPX, and MCO. I have also screenshot these two indicators to the lecture notes, and let's get back to the lecture notes. All right. Again, this function, EMA function, is only for my trading app. You can basically change it, replace it to another one for different trading app. Okay. Now I need to give you a massive quantitative warning. Traditional textbooks say the MCO is exhaustion at 100 and minus 100. But those numbers were based on the entire New York Stock Exchange, which has over 3,000 stocks. Because our ADD-SPX script only looks at 500 stocks, the mathematical scale compresses. Look at this chart from April 2026. The blue line crosses the zero axis, confirming a bullish regime, but notice the scale. It only swings between -4 and 7 for the S&P 500 MCO. A rating of +10 represents the exact same euphoric exhaustion as the 100 reading on the broader market. And two more comments is that this S&P 500 can represent the entire market, okay, as we did in chapter 1. So this is a really a good indicator. And also, I said something wrong that I said that we took NVIDIA as an example, but this is actually for the full market. So ignore what I said before. Okay. Let's move down. The single most powerful warning sign in quantitative finance is breadth divergence. If the S&P 500 pushes to a new all-time high, but the McClellan Oscillator prints a lower high, it proves the rally is hollow. Institutional capital is quietly exiting. Major historical market crashes are almost always preceded by severe breadth divergence. How do we apply this to our afternoon golden window? We use the McClellan Oscillator and the ADD SPX as our ultimate macro veto. If you find a beautiful MACD golden cross on an individual stock, but you check your macro breadth and the S&P 500 is plugging into severe negative territory, you veto the trade. We do not fight the macroeconomic tide. We only buy individual stocks when the broader market breadth gives us permission to do so. Okay, we can now measure the trend of a stock and the breadth of the overall market. But how do we measure fear? How do we quantify system risk? In our next lecture, we are diving into the VIX. See you in the quant lab.